Welcome to British Pension Update, where your retirement dreams meet real financial advice. Stay tuned as we uncover the latest tips, updates, and secrets to make your pension work harder for you. Let's secure your future, one smart step at a time. UK families, listen up, a major pension change is coming that could see 40% tax taken from unused retirement savings. If you thought your pension was safe to leave as inheritance, think again. Here's what you need to know before it's too late. This change comes via a policy announced in the Spring Statement 2025, from 6 April 2027, pension pots that haven't been used like defined contribution pensions and workplace pensions will count as part of your estate for inheritance tax, IHT, purposes. Previously, many of these unused pensions were exempt from IHT in your estate. But with the new rules, that exemption largely disappears. What does this mean in practice? Suppose someone dies and leaves a pension pot worth, say, £500,000. Under the IHT rules, anything above the £325,000 nil rate band could be liable for 40% inheritance tax. That could mean tens or even hundreds of thousands taken by HMRC, a blow to the beneficiaries who might have expected the full pension as part of their inheritance. Importantly, this applies even if the person died before accessing their pension, meaning death in service or unused retirement pots are no longer automatically protected. Also, if you were relying on your pension to pass on wealth tax-free, this reform changes the game. The government has framed the shift as closing a tax loophole. They argue it aligns pensions with other assets in terms of inheritance tax fairness. That said, the number of estates actually affected might be relatively limited, according to HMRC's own summary. The government estimates that around 1.5% of deaths may result in a new IHT liability on pensions under these rules. Still, for families who are impacted, the sums could be significant, and the policy is already sparking concern and criticism. There's also a knock-on effect. Your pension savings are no longer just a retirement tool, they could be part of your estate planning strategy in ways you didn't expect. Financial advisors are now urging people to review how much they leave in their pension versus other assets, especially if leaving a legacy is a priority. So, what can you actually do if this applies to you or someone you love? Reassess your pension strategy. Think about whether it makes sense to draw more from your pension now, while you're alive, or to take advice on the tax implications of leaving large sums unused. Estate planning matters more than ever. Talk to a financial planner or tax specialist. Use wills, trusts, or insurance to structure your inheritance in a tax-efficient way. Check your pension types. Know whether your savings are in defined contribution schemes, workplace pensions, or other vehicles. Not all will be equally impacted. Stay informed. The details are still being worked out. How the IHT charge applies, how pension scheme administrators report this, and how much flexibility beneficiaries will have is still under discussion. This change isn't just a tweak, it's a significant shift in how pensions are treated after death. For many UK savers, it turns part of their retirement nest egg into a potential tax liability for those they leave behind. If you or your family are building a pension, planning to retire, or just want to leave a legacy, this is a wake-up call. It's time to look beyond just how much you're saving and think carefully about what happens after. Thanks for watching. If you found this helpful, hit subscribe and the bell so you never miss a pension update. Remember, your financial future is in your hands.